Hey guys, Genevieve here. So I wanted to really dig into a 2-1 buy down and consider the different things that a buyer would want to look at in choosing whether to do this or buying discount points. So let's say you're pre-approved for a 6.5% interest rate and you've negotiated with your seller to give you about $7,000 towards your closing costs. Where do you put that? A 2-1 buy down and buying discount points are both front-loading the cost of interest. The difference is that a 2-1 buy down is temporary and buying discount points is permanent. So let's take that $7,000 and put it towards discount points. If you do this scenario, let's say it brings down your interest rate from 6.5% to 6%. This will be permanent for the full 30 years of your loan, which is going to save you a ton of money over that lifetime. However, if you want to go for a 2-1 buy down, this is going to give you a lot larger relief, but for a short period of time. So for your first year, you're actually going to get 2% decrease from the normal rate. So instead of 6.5%, you're going to have 4.5% for your first year. For year 2, it's a 1% decrease. So you'll go from 4.5 to 5.5 for year 2. Year 3 and beyond will be 6.5%. So this isn't an ARM or an adjustable rate mortgage where you don't know how or when it'll change. You know exactly where you're getting into. It is going to change over the lifetime of that loan based on year 1, 2, and then 3 and beyond. So how do you consider which one to go for? If you're going to stay in the house long term, maybe that savings that you would see from 0.5% over 30 years is what you want. Now, if you're only going to stay in the home for a short time, maybe you want that relief over the first 2 years because you're going to be getting a raise next year, or you see your financial situation changing. 2-1 buy down might be for you. Another consideration is if you want to gamble a little bit and you think the rates are going to be lower, then a 2-1 buy down could be great to get you into that house at a discounted rate. Then you can refinance if and when those rates drop. At that point, if you refinance or you sell the home, you actually are going to get a rebate from whatever the seller paid towards buying down that rate that you didn't get to use. So I hope that helps a little bit, and let me know if you have questions.